Let's get more on the banks and bring in Christopher Whalen. You've seen him here before, chairman of Whalen Global Advisors. Chris, great to speak with you.
Hey, good. Nice to speak with you, Melissa.
Tim opened up by saying a lot of them are inexpensive. So that begs the question, value trade or value trap at this point?
Well, I was a buyer coming out of April, especially for my preferreds. I've been rotating into them because they were so cheap. You could buy income up the capital structure below par, and you don't get that very often. And I had also loaded up on a bit of U.S. Bank, but frankly, between then and now, I just decided that I still have no visibility on credit to, your conversation, right? And I think that's what's weighing on the street. We had a nice rally. We had JP back at 1.3 times book at one point. And they're still relatively strong, the good names. But the weaker names in the group have been suffering. Capital One, I even worry about Goldman because, we have issues with them and they have high risk franchises, both in terms of credit and other types of risk. So I think the street's pulled back because we still don't know. And we still have no guidance. There's no guidance out there. And the street has pulled their estimates back too. They're talking about this year. That's really all the visibility we have. So what I tell people is watch credit. If credit comes in light versus Q1, that's good. That tells you, to his earlier point, right, it tells you people are getting more comfortable with what's coming.
Right.
But if we're loading another $50 billion on the fireplace for the remainder of the year, then that tells you that we see a big credit loss coming for the full 2020.
So, Chris, oftentimes we talk about financials, we talk about banks, sort of a monolith, but obviously there are many different types of financials in that basket. So when you're saying that you're concerned about credit and concerned about credit losses, the big unknowable here at this point in time, what sorts of credit are you most concerned? I'm trying to get at, which financial has the most exposure to the most concerning kind of credit to have?
The small commercial customer, which is typically a small bank customer, worries me a lot. Main Street, Melissa. Think of all the different types of small to medium-sized businesses that have been impacted by COVID, right? It's an enormously wide swath of the economy. As you go up the food chain to the bigger banks, the U.S. banks, the J.P. Morgans, they're good performers. They know how to manage credit. I'm not worried about them, but I am worried about some of the narrower businesses like the Capital Ones that are facing, not today, but maybe in October, November, a big uptick in unemployment and a big uptick in credit costs. I'm very concerned about the number of enterprises that have managed to support their employees and keep everything together for a few months, and now they're letting people go. I had a young man serving me dinner the other night in Stone Harbor, New Jersey, who had been a marketing executive for Alvin Ailey Dance Theater, and they had to let everybody go. So think about that kind of example multiplied over this entire consumer small business complex. And then meanwhile, we're going to have a record year in residential mortgages. It's going to be well over $3 trillion this year, up 40% on volume because of the Fed. So that's a bright spot, but I think consumer and commercial credit, anything having to do with multi-use, commercial real estate that has any kind of a retail aspect to it is going to be in big trouble.
Hey, Chris. What do you think? Do you think this is just more of a macro call? When you look at the XLF, it's down 23% year to date. When you look at the XLK, it's up 18% year to date. Is this less to do with the banks specifically and more to do with investor preference?
I think it is a combination of the two. I think a lot of investors don't fully understand what's coming at us because it's not like 2009. This is not a liquidity crisis. This is kind of a grinding credit discovery process and resolution process, which is going to take years. And I think, when we talk about the 30s as a comparison, we may need help for the courts and for governmental agencies around the country to deal with the dislocation of this kind of credit event. It's more like the mid-30s. And I think that's where we have to focus people because, the strength of the U.S. economy is that we resolve things like this quickly. We don't let them sit around. But I do think, between this year and next year, it's going to be a tough story for banks. You know, the estimates have earnings down 50% this year from last year. I think it's going to be more than that.
Okay. Chris, thank you.
Okay. Thanks, guys. Be well.
Chris Whalen. Guy Adami, in terms of the most troubled areas in financials, Chris, you know, pretty much hit it on the head in terms of the ones exposed to small and medium-sized businesses. That would probably be regionals.
Yeah, and it's interesting. No, and Capital One was the one of the names he mentioned. And, you know, what we're seeing, and I think we've talked about this now for a while, the have and the have-nots in terms of companies that have done things well and companies that have just impaled themselves. And I put Wells Fargo in the impaled themselves category and trading at a steep discount now to tangible book. And maybe you get a trading bounce off earnings next week, but think about it. They took a $13.7 billion loan loss provision last quarter, which is up 413% year over year. You got to wonder what happens this quarter. Again, maybe you get a bounce. I do agree with Tim that J.P. Morgan probably is absolutely worth the trade at these levels, given that seemingly, 30 or so trading days ago was a $115 stock. But I'll say this, and I'm not suggesting anybody does this on this panel or on the network, but you can't look to the banks when they're doing well and say what a barometer they are for the broader economy and then discount that when they're trading poorly, which they are now. It's good. If it's good on the way up, you got to take the bad on the way down. And I do absolutely think the banks are telegraphing something here.